Hi, I'm Ken Fryer, Chief Investment Officer of Atlas Capital Advisors. Welcome to our market commentary for May 2024. May was another strong month for the stock market. We've now had 6 months out of the past 7 in which global equities went up. It was an especially good month for U.S. stocks. The S&P 500 was up 5% in May, and that's the best May for U.S. stocks since 2009. So why have stocks been doing well, and how can we understand where we are and what happens next? The best framework is to look at the economy and inflation and their effect on investments. So let's start with the economy. I found that the best way to understand the global economy and how it might affect investment markets is to simply look at the proportion of the global economic data which improved in the past year. That's the blue line on this chart. If the proportion which improved in the past year is less than 50%, which means most economic data got worse, and if more and more economic data are getting worse, that is, the blue line is falling, those are the situations where the global economy has had a negative impact on the stock market. They're shaded in gray here. Now let's look at inflation. The blue line on this chart shows year-over-year consumer price inflation in the United States. When we have an inflation problem, inflation is 3% or higher, and it's rising. Those are the periods which are shaded in gray on this chart. Putting inflation and the economy together, there are 4 possible states of the world. Starting in the upper left in this schematic is the best possible state. There's no economic problem, there's no inflation problem. That has happened 60% of the time in the past 55 years. Moving clockwise around the framework, in the upper right, we have an economic problem, but not an inflation problem, which has happened 14% of the time. Lower right, both are a problem. That's happened 12% of the time. And then lower left, an inflation problem, but not an economic problem, 14% of the time in the past 55 years. The state of the economy and inflation has had a profound impact on investment outcomes, particularly on the outcomes of the stock market. As you can see on this chart, in the double positive state, both economy and inflation are fine. The average annual return of global equities has been 12% real. Whereas in the double negative state, the average annual return of global equities has been negative 18% per year. So truly bad results when both are negative. Whereas looking at the bond market, the green state has been good for bonds, 3% real return. But the best state for bonds has been when in the gray state, when the economy is a problem, but inflation is not a problem. That in that kind of state, central banks can lower interest rates in good conscience because they don't have to worry about inflation. Looking over the past 5 years, we visited every quadrant. The worst time in the past 5 years for equities was in 2022, and with good reason. That was a double negative period. Inflation was high and rising, and the economic data was softening. The best time for the stock market has been the double positive periods, where the economic growth is improving and inflation isn't a problem. We have been in that good state for more than a year now. So how will we know when we've moved quadrants? Well, as this framework explains, it would either be because the economic data starts becoming worse or because inflation starts getting higher. If either of those happens, we'll move to a different quadrant and a less benign state for financial markets. And for us as Atlas Capital Advisors, we're data-driven quantitative managers, we'll make appropriate adjustments to client portfolios when the quadrants switch. So that's how we look at things. Thank you for listening. And if you would like to learn more about us and get updates on how we're positioned, please visit our website at atlasca.com. Thank you.